you can start there, but don't end there, because if you're getting an asset, you should be looking for an asset with wonderful amount of intrinsic value that you can unlock, increase that net operating income, and get a debt service coverage ratio of at least 1.5, 1.8, 2.2, where you're getting a 50, 80, or 120% margin of safety above your debt, because someday that tide's going to go out, and it's really important to have a wonderful margin of safety.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
Hi, I have Paul Moore here with me today, and Paul and I were just talking about what do I get out of running these shows? Like, his direct question to me was like, okay, Christina, I've known you for a while. What's the true gig about what you get out of running these shows? And I was like, it's the Christina show. I get to be Christina one more time. People get to see me, listen to me, hear me talk, hear me do my shtick, and get a sense for who Christina Suter is. But honestly, guys, you know what else I get out of it? I get to talk to people like Paul Moore, who I normally would not get to talk to. He'd come to my meeting, he's nice, he'd like present, and then he'd go home. But here I get to sit and do face-to-face, one-on-one conversations with experts in the field and get the real news on the street of what they're experiencing and their opinions. I have a question today for Paul, because Paul in particular is gone from one industry to another industry. And I'm like, Paul, tell me the truth. Why did you go from this industry to this industry? Because you, Paul, are not a man who moves easily or lightly. You're very thoughtful about what your choices are and why you are where you are. So I'm going to read his bio, guys, so we can kick this off, and then we're going to be able to jump into these questions. So Wellings Capital, Paul Moore's company, and I do have the other tab up as well. Here we go. Paul Moore, managing partner of Welling Capital. Paul Moore is the founder and managing partner of Wellings with an S, Capital.
Not Wellington.
Not Wellington. Do you know how many times I've typed in Wellington? Do you know how many? I am so guilty. Wellings Capital, Wellings. Are you well? Yes, I'm Wellings. Thank you. It's the type of conversation my daughter and I would have, like, hey. All right. Yeah. After graduating with an engineering degree and then an MBA from Ohio State, Paul entered the management development track at Ford Motor Company in Detroit. After 5 years, he departed to start a staffing company with a partner. They scaled and sold the company to a public trading firm 5 years later. I loved your answer last night when we talked about that. After a brief retirement in his early 30s, Paul began investing in real estate in 2000 to protect and grow his own wealth. He completed over 85 real estate investments and 85 real estate investments and exits, which I think is profound when you start to try to understand who the experts are in the field. How many exits they have, honestly, is a really good way to start to understand their depth of experience. It's not just the entrances, it's the exits. Appeared on HGTV, House Hunters, rehabbed and managed dozens of rental properties, and developed a subdivision. After completing 3 successful real estate developments, including assisting with the development of a Hyatt hotel and a very successful multifamily project, Paul narrowed his focus on commercial real estate. In 2011, Paul is married with 4 children and lives in Central Virginia. And you have been an Ernst & Young Michigan Entrepreneur of the Year, 2 years straight, finalist.
Yeah, finalist.
Oh, finalist. I missed it.
Yeah.
Contributed to Bigger Pockets. Bigger Pockets published your last book, which I no longer have a copy of because I gave them all away last night.
Oh, no.
Don't worry. I know where to find you. I know how to get another one. Not a problem. Let's see. Fox Business, author of The Perfect Investment, Creating Enduring Wealth with a Historic Shift to Multifamily Housing. And now your new book, Storing Up Profits, Capitalize on America's Obsession with Stuff by Investing in Storage. So that's kind of where I'm going to start with. We're just going to go straight to there's 2 fun topics we're going to have, guys. So hopefully we'll get to both. The juice. Paul.
The juice.
You moved from multifamily into storage. You're not a man who moves lightly. You're very thoughtful in your due diligence. You're very intentional in your investments, and you protect your investors well. There was no way you'd make that move without really good reason why. Now, I have confessed already before we started to Paul, I own no multi-units anymore. I used to. I actually own several. I no longer own any. The multi-unit market has truly changed. So Paul, go to town and tell us your opinion on why you went from here to here and compare and contrast.
Okay. I lied to my wife.
Oh no.
I didn't mean to. I didn't mean to. After jumping around quite a bit
Yeah.
in my early years, I thought I was a full-time investor, right?
Right.
I thought I was not. I was a full-time speculator when I started out. I didn't know the difference between investing and speculating. I hadn't read Benjamin Graham. I hadn't read Warren Buffett. And I came to the conclusion after many years that investing is when your principal's generally safe and you've got a chance to make a return, and speculating is when your principal's not at all safe and you've got a chance to make a return. And I
that
found
way,
that
I lied to my husband too. I am guilty as charged. I have
Did
lied
you?
Also. My husband would say the exact same thing.
Oh man,
Yeah,
I'm
'cause he's been with
sorry.
me
Maybe
for
he and I
16
should get
years.
together.
Yeah, you guys we can commiserate on our lives for our partners. Well, and we grew. So keep going because we grew. Continue.
Yeah, right. So when I got into multifamily investing after doing these two projects in North Dakota, I said, I'll never do anything else. I mean, I was in my 50s. I was set on this. So I wrote a book humbly entitled The Perfect Investment.
You did.
I found out after years of pounding my head against the wall, trying to find assets that made sense, it might not be true. It's not the perfect investment if you can't find deals that pencil out. Now, I'll confess that our acquisition team was lame. We did not have we did not have the experience. We didn't have the team. We didn't have the inside track record. We didn't have a track record finding, off-market deals that other people did. But at any rate, every time we did bid on a deal, whether it's on or off market, we got outbid. And, it's funny now, like the deals in 2014 that seemed overpriced seem, happily underpriced now. But at the time, remember, you can only tell where you are in the potential of getting, hitting a bubble in a rear view mirror. It is not possible to see through the windshield and say, we just hit the top. Or, like Warren Buffett talks about, we're dancing in a Cinderella's ball when the clocks have no hands. We don't know where we are in the cycle until we look back. We didn't know, but we found ourselves feeling, after saying, I want to be an investor now, not a speculator, and I want to stay in multifamily the rest of my life. I found those things were not congruous because I was starting to feel like a speculator. And I was starting to feel like to compete, I had to overpay by either 10 or 20%, which could have translated to millions of dollars in 100+ units we were trying to buy.
That's right.
And so I got really frustrated and I, didn't know where to turn next. And I got a call one day from a guy named Chris. He said, I'm a multifamily investor too, but can I tell you why I'm switching over to self-storage? And I rolled my eyes. He couldn't see me. And I said, sure. And I thought,
why don't you train me?
Yeah. So I really didn't want to do that. I did not want to hear about self-storage. I knew for sure that I would stay in multifamily. But as he talked, I realized, wait a minute, this could be exactly the answer to my problem. Because he told me that self-storage, he told me a lot of the benefits of self-storage. And if you want, I can run through a few of those that he shared with me.
Yeah, let's do it.
Tell you why I think self-storage is uniquely positioned right now, honestly, relative to multifamily. So
yes, let's hear it. I happen to agree. I have my own little theory I want to add to your conversation, but I want to hear what you have to say first.
Okay, great. Well, I mean, he started by getting my attention this way. He said, look, if I'm renting $1,000 apartment from you and you raise the rent 6%, of course, that was before the big inflation, right?
Right.
You raise the rent 6%, I might leave rather than pay an extra $720, $60 a month for your apartment. But if you raise my self-storage rent by 6%, I'm renting it for $100. And you
Right.
say, okay, so it's
Dollars.
6% more. I'm probably not going to spend a weekend, rent a U-Haul, get my friends together just to move my junk, my treasures down the street just to save $6 a month.
Right.
And so that got my attention. Then he reminded me, he said, self-storage actually did really well through different downturns. It's actually done well in bad times and good. And I was like, really? He said, yeah. He said, think about it. He said, in good times, people are loading up their Amazon and Walmart carts and they need a place to store their stuff. In bad times, people might be downsizing and they need a place to store their stuff. And of course, that was pre-COVID, Christina.
Yeah.
In COVID, people were shutting down bars and restaurants, people working from home, offices. I know a guy with a ton of office space, his company leases,
Right.
and they're shuttering it and they need a place to store that stuff.
Right.
And so COVID has just accentuated this trend, but I'll get back to that later.
Okay.
The tenants don't mind a little price increase. And one funny thing is during inflation, I mean, if you own an Amazon warehouse, you lease it to Amazon, like a guy I know, for 20 years, your rates are already set. With self-storage at the other extreme, you can raise the rents every month to capture inflation. And that's exactly what people are doing right now. The thing I love most, though, is this. A study that somebody I know did said that 93% of large apartments, those 50 units and up, are owned by corporations that often bleed out all of the value add opportunities in advance. And so they're already pretty well run. Not all of them, of course, but 93% are owned, these are owned by companies who have multiple assets.
Mhm.
Self-storage is quite different. 75% or so are independent operators. And
Mhm.
of those, 2 out of every 3 own one asset. And that makes them a mom and pop owner.
Yes.
If they're a mom and pop owner, they typically don't have the desire or resources or knowledge to increase income and to maximize value for their investors. Hey, let's be honest, they don't need to, because the price of their facility, even if they're mediocre, has already effectively doubled in the last 7 years just by the market sentiment. In other words, cap rate compression. There's 53,000 self-storage facilities in the US, though. That's about the same size as McDonald's, Subway, and Starbucks combined. So there are a lot of opportunities, and there's a lot of upside in this business. And when someone mentioned value adds in self-storage to me, I think I laughed out loud. But I thought, well, wait, there's 4 pieces of sheet metal, some rivets, a floor, and a door. Where are the value adds? Where are the countertops and bark parks and
washer and dryers,
all those wonderful things?
Refrigerators.
Yeah, you sweep out the unit and re-rent it. Well, I found out there are tons of value adds in self-storage, and many of them don't cost a dime.
Tell me. I'm like drooling. What? Tell me.
Okay.
What are they?
Well, here's a big one. Let's talk about U-Hauls. So you can rent U-Hauls out of your self-storage facility. You can contract with U-Haul. There is a cost to that. You have to buy a computer to run the U-Haul business. That's it. That's the only capital expense you have, and you can make anywhere from $1,000 to $5,000 a month in commission. So let's do the math on just that one. Let's say you buy a self-storage facility for $2 million. That's $800,000 in equity and 1.2 million in debt, let's just say. So 60% LTV. Okay. You add self-storage and you make, you add U-Haul and you make, let's say $3,000 a month. That's $36,000 a year. $36,000 a year. The value formula in commercial real estate, your listeners know because you've trained them well. The value equals the net operating income divided by the cap rate, or the rate of return. And so if you added $36,000 a year to the net income, first of all, you can pay for an employee with that money. But secondly, you divide that by 6% cap rate, 0.06, and that is a $600,000 increase in the value of your asset. Well, if you have $800,000 in equity in this facility, You just increase that by 600,000. The bankers don't share in this profit. And you just got a 75% appraised return on your equity by adding one value add. Okay. And there's a lot more. We can fill vacant units. A lot of mom and pops have a lot of vacant units. We can raise the rent by 10 or 20 or 30%. A lot of them don't have a website and marketing, and you can add that, and you can, that'll help you raise occupancy and rates. You can add a billboard. You can lease a spot for an ATM or propane filling station or cell tower. You can add point of sale items like selling locks, boxes, tape, scissors, insurance, tenant insurance. You can charge late fees. You can gravel that 6 acres out back incrementally, gravel or pave it, and put in boat or RV stores.
Parking, that's right.
Lots of value adds.
Yeah. Paul, I love that. I love that. I really, really do. I just love it because it's like, that's what I mean about the due diligence. Like, let's get down to the math and the reality of what we're facing. You know, I'll hijack for a minute. So I started in residential. I moved into multifamily. That was what I did before the 2006, 7, 8 movement of real estate. I was all residential. That's what I did. And when I was looking for my first apartment building, it was in Van Nuys, California. And my cap rates ranged between 7 and 8% cap. And I could buy a building in Van Nuys, in greater Los Angeles area, and cash flow pretty comfortably because my interest rates weren't even close to the 7% at the time. Right. So I made money on my money. I made money on above and beyond the loan payment. I was happy. I had cash flow. That to me was what a multi-unit was. It was a cash cow. It was about stabilizing your equity in a hard asset that would hold its value in general, not all the time, but in general, and be able to receive monthly cash flow off of it as long as you had some level of professional property management in place. That doesn't exist in LA, in most of LA. There's a whole other creature, and I'm not even going to go into the other creature, right? That's not the purpose of this conversation. The purpose of this conversation is being able to understand what happened to multi-units and going to storage, and why going to storage is a knowledgeable investor's choice. Now, that's one. Two, the other piece you hit on, and I'm glad you said it, was I have noticed, and maybe you've noticed too, that when a field, a niche in real estate gets professionalized to the point where 80% or more of the units are owned by some version of professionals, industrial professionals, there is this incredible level of competition that occurs. There's not enough mom and pop units really for smaller investors or professionals like us to get in there unless we're pulling in a whole contingency of other professionals to support us. Right? We have to become this larger player. Right? And I'm not a BlackRock, Blackstone. I'm not whatever the company's name is. I apologize for blanking on the name.
Both of those. No, BlackRock and Blackstone. You're right.
Okay, good. I'm not imagining things. But when you say storage units and 75% are still mom and pop owned, then there's an opportunity for a mid investor. I don't know what to call us, but some version of a mid-range investor. I would say you're actually more professionalized in running your crews and your teams and your syndications. I take other people's money. I mean, come on, like I do joint ventures and flips, and I don't do syndications like you do. So I'm smaller than you are, right? But there's a much bigger opportunity to do the value add. I explained to my daughter what flipping was. She's like, Mom, can you really buy a house and sell it for more? Is that legal? I went, yeah, it's legal. I said, it's like buying an old junk of car and making it all really pretty again and drivable so a family can use it. And then you sell it. And she went, oh, I get that. But you got to have the old junk of cars to find.
Right.
And if we can't find the old junk of cars to do our job to make it better, therefore work again and contribute and more valuable and get paid for that process, then, I'm priced out of the field. And to me, that's what's happened inside of multifamily.
Right.
Your opinion?
It's absolutely true. Well, To your point, let's think about why Blackstone and BlackRock can do this. First of
Okay, let's
all,
do it.
their cost, I know somebody who knows them really well.
Mhm.
And he said their cost of capital is like, debt is like 2%. And so if they can get a 5% cap rate deal, they're going to make a big profit.
Okay.
The problem is, or even a 4% cap rate in some cases, right?
Yeah.
The problem is when you try to compete with them and outbid them, you have to bid more than them. It can be a real problem if your cost of capital is 5%,
Yes.
right?
Yes, right there, right there. I'm
So
sorry.
that's one problem.
Yeah.
Let me tell you this, the best multifamily operator that I know, I mean, this guy's been doing it like 20 to 25 years. He's been in real estate 30 or 35 years. He told me that he has a multifamily property that's not performing well for whatever reason. It hasn't been able to raise rents. It's barely covering, like the debt service coverage ratio is dangerously low, like 1.0 to 1.1. So it's, in other words, it's barely covering the debt payment every month. And he's got a professional management team who hasn't been able to do any better. His cost of capital is about 2%, sort of like Blackstone. Okay.
Okay.
He said someone just paid him 50% more than he had in this property to acquire it from him. Now, how's that going to work? He said they're starting out with debt at about 4.9%, about double his, and they're paying 50% more. How's that going to end for those investors? I got to ask that, Christina.
No, I got to ask that too. I mean, apartment buildings to me were never an appreciation play. That was never their intention in my world. They were always the cash cows. They were about cash flow. They were about having multiple units, being able to have a controllable vacancy factor, offering an asset that's always going to be desirable, and therefore you can always get the cash off of it. Oh, and by the way, it'll probably appreciate because you raise rents 3% a year.
Yep.
That's not the game anymore. The game in major cities, not in secondaries and tertiaries, right? That's why a lot of syndicators have moved into secondary and tertiary cities for their multi-unit deals, is that in major cities, it's now an appreciation plan. I'm like, that's called a straight up flip. If I want to do that, I'd buy a single family.
Yeah.
Right? I mean, maybe I'm small, right? But that's what they're doing. They're treating it very much like an appreciation plan.
Yeah, I agree. They have to. And if you're counting on appreciation, your business strategy is based in hope, and hope is not a good business plan.
And it brings you closer to speculation.
Right? It is total speculation.
Right? Because it's like, are we in a recession right now or not? I don't know. Not everybody's in agreement about whether we've entered into a recession. And several people are like, no, we aren't. I'm like, well, I looked it up on Fred the other day, and supposedly we had a negative quarter of gross domestic product, and yet we have 8 to 9% inflation, right? So I'm super curious to see what in 3 months. I might do another economic update in 3 months, just because I'm super curious to stay with it. Like, this is where we need to start babysitting the market. Like, what are our numbers? What's happening? What's the flow of the tide? Because the tide comes in and it goes out, and it doesn't ask me permission to do it.
Right.
And didn't ask me permission, didn't send me a letter, didn't say, oh, by the way, I'm coming into town. Right.
Right.
It does its gig, and the best we can do is be responsive to it. But like you started this whole conversation with trying to time it, it's a little nightmarish. I know a lot of day traders that are not happy people. Right?
Yeah, I bet.
Trying to constantly time things. So is there more you want to say on that, or should I jump to my other topic?
I will say one other thing is that we can benefit from, in self-storage and other asset types as well, is putting together a portfolio, buying from mom and pops, upgrading them, increasing the debt service coverage ratio, decreasing the LTV, putting these together in a commonly themed portfolio, and then selling it to someone like BlackRock or Blackstone. That is a fantastic opportunity, and they'll pay a premium. And so it is a great business plan. In fact, that's what our company does. We're not the operator. We're investing with operators who are doing just that.
Right, who are specializing in that. And it is a very good plan, because honestly, I mean, to me, Zillow was probably the good example, right? It's a company that tried to get in, a large company that tried to get into something that really is feet on the ground. And it's like, are we really good at that? Are we really good at having a team in multiple cities in order to get a crew on the ground to force the value out of this property, to bring the appreciation out? I'm not so sure that larger companies are the best at it. Smaller,
they don't want to, right?
and
They
see,
want to buy stabilized properties.
stabilized
They don't
property.
want to buy mom and pops.
Yeah, they don't want, and it's like 50, which is why it's the cutoff was when you said the professionalization of the ownership of multi-units was 50 units and above, because it's not below.
Right.
Right.
Yep.
All right. I love that. Now, last night you talked about Warren Buffett, and we specifically chose that topic. There's lots of topics you can talk on. We happen to have chosen that one. One, because you are creating another book that will hopefully come out with the Warren Buffett principles in it. So I'm going to share my screen here for a minute. So this was I call it your blue book, because it was the one that was about your multi-units. This is the book that you just finished. I call it your red book because it's got a red cover.
The
right?
blue pill and the red pill.
The blue pill and the red pill. Are you going Matrix on me here, Paul? Is that what you're telling me?
I'm thinking about it.
You're thinking about it? You know, this world is an amazing place, especially, oh, you know what? I know you would appreciate this comment. It occurred to me to share it with you. So there's a movie called Serenity. It's a silly movie with lots of fights in it. But there's a female lead who's like really skinny and really like just, agile and beats the crap out of people, right? So, what can I say? My kind of movie, right? But one of the lines in the movie was the male lead is talking to a longtime consigliere of his, right? Somebody he respects and listens to. And he said, his consigliere says, I need you to believe. And he's like, stop talking God to me. And he says, why do you always think I'm talking God to you? I don't care what you believe in, just believe. And I'm like, I personally think it's the same thing, right? Like, there's a state of believing. There's believing in what we're investing in. There's believing in a greater purpose. There's knowing that we're on course. And so when you start talking about going from the blue book to the red book, what pill do you want to have in you want to take? Like, I don't care, as long as you believe in something greater than yourself. Pick it. I don't care what it is. Yeah. Believe in being a good human being. Believe in Buddha, right? Believe in God. Believe in Christ. Pick your person, your personality, your persona, whatever it is. But just pick a belief. And I think one of the things that's valuable about people that are leaders in our field, like you and Warren Buffett, is that you guys have been investing for so long that it becomes this elegant process, right? There's a belief in the process, is a belief in the elegance of it. And Warren Buffett tries to talk to that. So it may have seemed like I was going totally tangential, but I tried to tie it back in again. And
you did a good job.
Thank you. I worked hard on that. So let's talk a little bit about Warren Buffett, and a long-term investor with a lot of grace and a lot of understanding of how you can work in relationship to a market that will move on you.
Right. Well, Warren Buffett has a lot of funny and really helpful, insightful sayings he's said over the last 60 years. And so we've collected a lot of those that apply to investing in companies and stocks and tried to apply them to real estate. So we're calling this Warren Buffett's Rules for Real Estate Investors. And how about if I give you a few?
Yeah. Yep, you would.
All right. So we all know that the rising tide has lifted all boats in all types of real estate this last 14 years.
Yeah.
Warren Buffett says, someday that tide's going to go out, and only when it goes out will you discover who's skinny dipping.
Who's wearing a suit?
What's he talking about? What he's talking about is the difference between experts and amateurs. You cannot tell the difference between experts and amateurs in a good tide, in a rising tide, because they're all getting the same types of results. There are people, Christina, who were in high school. There's nothing wrong with this. They were in high school during the Great Recession, and now they're billed as top thought leaders in multifamily and other asset classes. And there's nothing wrong with the fact that they were in high school. We were too at some long ago point. And
Oh,
But here's the thing. Do you really want to give them your money? Christina, you talk about 50,000. That's a car. Do you
talk
really
about
want to give
exits.
them that car and trust them to
Oh,
drive it well?
right.
Well, the
That's right.
problem is we really won't know who's driving well until there's a downturn, until the tide goes out. And that downturn, my friends, is coming. It's
Mhm.
always coming at some point. It's just, again, it's real hard to predict when it is. Warren Buffett absolutely says, I will never try to predict when or how far it will go. I will only act appropriately in this moment.
Right.
And so Warren Buffett has, again, I love that quote. And how do we apply it as real estate investors? Well, I mean, if you're the investor taking other people's money, be a great operator and stress test everything you're doing for a margin of safety.
Yeah.
And if you're investing with an operator, make sure they have a margin of safety. Buffett also said, we insist on a margin of safety in our purchase price. If we calculate the value of a stock to be only a little higher than its price, we don't buy. We believe in this margin of safety principle to be the cornerstone of investment success.
Mhm.
Well, if you're an engineer or a professional, a technical type person, you know about the margin of safety. Like when you design a bridge. In that class in engineering school, I had to really, I was very puzzled. Why do you have to build a bridge to hold 120,000 pounds if the limit on that bridge is 40,000 pounds?
Exactly.
Well, I didn't know that in the 1800s, a huge percentage of bridges failed. In fact, I believe it was 1 in 4 bridges failed and people lost their lives. The margin of safety is really important. And for real estate investors, that can be a debt service coverage ratio, which we already touched on. It can be a loan to value ratio, which is, kind of the long-term correspondent sister to the DSCR. The
Mhm.
bank might say you can get away with a 20% debt service coverage ratio, which means your ratio of net income to your debt payment is only 20%. You can start there, but don't end there, because if you're getting an asset, you should be looking for an asset with wonderful amount of intrinsic value that you can unlock, increase that net operating income, and get a debt service coverage ratio of at least 1.5, 1.8, 2.2, where you're getting a 50, 80, or 120% margin of safety above your debt, because someday that tide's going to go out. And it's really important to have a wonderful margin of safety.
It's a great example.
So
Perfect.
that, yeah, I mean, thank you. So like getting a margin of safety would be, not counting on 7% rent increases every year to make it work, or not getting, 82% loan to value ratio, even if the bank winks and says it's okay, because then you're speculating and it's just not a great thing
And
to
you're
do.
literally setting yourself up. You're
You
literally
really are.
setting yourself up. As soon as the first, as soon as the first, rough waves start to crash, your building, your investment is going to be the one that's at risk.
Yeah, it's absolutely true. And so one of the most important things in getting this margin of safety right, and making sure that you're not on the wrong end of the tide when it goes out, is to invest in your circle of competence. Now, Warren Buffett talks about the circle of competence. He also talks about your strike zone. So the circle of competence is basically not having a really, like, I'm on Bigger Pockets, and people say, should I invest in 10 different states, in 10 different asset classes, et cetera, et cetera. And I'm exaggerating a little bit.
That's fine,
But
but
the circle of competence is basically the area that you know really, really well. Think about this. You never would have heard of Michael Phelps if he would have said, well, I'm really hoping to get 28 gold medals. And so let's see, to do that, I'm going to do javelin and shot put and long jump and running and swimming.
Yeah.
He would have been not an expert in any of those things, and
Yeah.
you never would have heard of him. He wouldn't have even made the team.
Yeah.
Take the opposite extreme though. Well, take him. He was an extreme, like, circle of competence guy. He knew exactly what he was good at. He focused on it intensely. And by doing that, he became the most decorated gold medalist in history, to my knowledge. And the rest of the team and the rest of the 320 million Americans were able to sort of take home that gold medal. And that's what it's like to invest with a syndicator or someone like you who takes people's money and is intensely focused on doing it right. Charlie Munger is Warren Buffett's partner, and he's got a friend who he decided decades ago to only buy real estate within 1 mile of Stanford's campus. How well is that going to work out? Well, it worked out real well. He actually became a billionaire. His circle of competence is really small, though. It's not real estate. It's not real estate in North America or America. It's not real estate in California. It's not real estate in Northern California. It's real estate within 1 mile of Stanford's campus. And he became a billionaire doing that. You can do the same thing by being hyper-focused. The best book that I can recommend to get this piece dialed in is Gary Keller and Jay Papasan's book, The One Thing, where they talk about hyper-focus. They say saying no is one of the most important things you can do. And I'll end with this Warren Buffett quote. He said, successful people say no a whole lot. The very most successful people say no almost all the time.
Paul, you are truly an amazing resource. I really, really, really appreciate it. You just nailed it. Yeah, you nailed it on both halves. I love the truly, like, I stopped investing in multi-units quite a while ago. Basically, as soon as it became the flight to safety and the cap rate started dropping below 5%, and I couldn't find a building that actually where they would list the cap rate at 5%, and then I'd run my version of the numbers, and I'm like, this is not 5. This is not 5. No, I can't do that. Right? I mean, that's literally an unsafe decision. And I love how you just pulled that right off. I love the numbers. I love the explanation of the numbers, how you add values to the building. I love what your company is up to recently, in that you guys are actually taking on that mid space between finding the mom and pops or finding units that are inefficient, making them truly efficient, being able to pull them together and pass them on to a larger company that's going to continue to operate them in a professionalized manner. I mean, it is the gap in between that so many of us fill in different asset classes, but you're doing that specifically in the self-storage units right now. And so Wellings Capital. So Paul, how do people get a hold of you?
Well, I'm glad you asked.
Tell me, Paul.
Wellingscapital.com. And if they want to get a special report on self-storage or others on mobile home parks or investing in commercial real estate in general, they can go to wellingscapital.com/resources.
Perfect. So WELLINGS, Wellings Capital. And how do they get a hold of you directly? Is there an email and phone number?
Yeah, they can email me. They can email me at info@wellingscapital.com, and my assistant will pass that along directly to me.
And she is delightful and incredibly responsive.
Thanks.
She's wonderful to work with. Thank you so much for listening in. This is Christina Suter with the Real Estate Breakthrough Show. You can find me on YouTube, Roku TV, and we're even getting an Amazon channel station, as well as iHeartRadio, Spotify, iTunes, and a variety of other podcast platforms. Tune in in 2 weeks for our next installment.